Welcome to Engage Investor. Today I'm joined by Lord Lee of Trafford, a politician, a lord, an active investor, and also the first ISA millionaire. Thank you for joining us.
My pleasure.
Lord Lee, let's start around politics. Why did you get into politics?
Why? I think always from a very early age took an interest in what was happening in the country and world affairs. My father's a doctor, and we at home sort of discussed things, as it were. It was really a general interest in what was happening in this country and the world that gradually developed an interest in politics. And I think I joined the Young Conservatives, for better or worse, of blessed memory, when I was, I think, 15 or 16, something like that.
And you also had posts in the employment and Ministry of Defence. Was that interesting?
Oh yes, yes. And it's a great privilege it's a great privilege to be a member of Parliament. Yes, you get a fair number of brickbats, but far more bouquets and thank yous in reality, because the public, of course, have a very sort of schizophrenic, Jekyll and Hyde view of politicians. As a generalization, they're dismissive. They say they're just interested for themselves, and they've got their nose in the trough, and they're this, that, and they promise this, that, and the other. But on the other hand, if you then say, well, what about your MP? Oh, well, that's different. He actually, when I wrote to him, he replied, and he came to our church fete, and he did this and he did that, as it were. So it's a rather curious mixed view that the public do have of politicians.
And also, that's not necessarily something that comes across when you watch the TV, etc. It's there. You don't necessarily have that mixed view sometimes of
No,
politicians.
I think that's fair comment. And certainly, now in the Lords, where I've been for
Yes, you so
17,
a life peer in 2000,
that's right,
2006.
17, 18 years. The public image of the House of Lords is very, very negative, not helped by the media, I have to say. But the reality is that when people come and listen to some of the debates in the Lords, they realise that they're of a much higher standard, broad brush than the Commons. And I actually regard, although the Lords, I think, are regarded as sort of fairly old and right of centre and out of touch, the reality is that I regard the Lords almost as a conscience of the nation in many respects. And if you look at their decisions, they're really almost sort of centre left,
Yes.
more than extreme right, as I think people imagine.
Now, moving on to your personal investments, as I mentioned, you were the first ISA millionaire, of which currently there are only 4,500 in the UK. How did you do it?
How did I do it? I think the key really was to recognise when PEPs came out, Person Equity Plans, the precursor to ISAs, in 1987. I think it was Nigel Lawson in his budget then which introduced PEPs. I recognised immediately that this potentially was a very attractive wrapper to have the opportunity to put a certain amount in each year, and have no taxation, no capital gains tax, and no income tax. So from 87 through, I think, to 2003, I think it was 15 years, something like that, I pretty well put in the maximum that I could do each year. Originally, we started, I think, with 3,000, and then it gradually crept up. So I put the max amount in, and also I reinvested all the dividends that came in. So compounding played a big part. And
Having said that, a 21% return per year is required to do that. That's quite impressive.
well, you're telling me, I certainly didn't get everything right. We make mistakes, and I still make mistakes. But I think it would be fair to say that I probably had more successes than failures. And also I benefited and have benefited through my investment life in terms of takeovers and take privates. So I worked out that I think I've been on the receiving end over my 65 years of investment life on the receiving end of about 60 takeovers or take privates, which, almost in every case produced a premium on prevailing prices and the liquidity then following the takeover to reinvest. Although I would have preferred some of those companies not to have been taken over to have grown.
Yes. And any of those initial investments still investments that you have now?
I don't think. Well, possibly one or two, like PZ Cussons, maybe. But then I had a historical connection there because I was on the board years ago. But I do focus very much on long-term investment. I mean, I believe that you only need two things for successful investment: common sense and patience. And patience is the most important, and patience is what most people don't have. And particularly in this age of technology, they look at the prices on the phone or whatever and see a profit. And so the temptation to take a profit and move to something else. And that's, excuse me, not the way to make money. You make money by getting into something good and staying with it. And the old American adage, you make your money by sitting on your ass, if I can put it as crudely as that.
But it is an interesting point, isn't it, when people look at investments relative to growth investments or ones that are paying a good dividend. And that is always a bit of a quandary for some people.
It is. I try and aim for both. I suppose in the past I'd very much focused on small cap stocks, whether AIM or main market, and in my good years I was focusing on, in the more profitable years, on buying into some good small cap stocks yielding 6%, 7%. In fact, I remember writing an article saying you should go for look for the double sevens, a 7p ratio and a 7 dividend yield, and you could get them in those days, and you can get them today. Because broad brush, a lot of small caps are fairly lowly rated at the moment. So patience is the most important. So one of my large holdings, for example, Treat in flavors and fragrances, I first bought that in 1999. And so you put the toe in, get to know the company, you like it, you build up. And I think I've bought on 30 odd occasions and added and built up my holding. And over the years, it has been a great success, although it's come well off the top.
Yes. So what's your appetite for risk then?
The key is to avoid the losses. And I draw a parallel between golf and the stock market. So the round is going well until the 17th hole, when you drive the ball into the wood or the river, as it were, and the card.
I can relate to that only too well, unfortunately.
Well, I certainly can, although I have a problem even getting off the tee, let alone getting into the wood. So the key is to avoid the losses, and almost everyone with a portfolio will have successes, but you've got to minimize those losses. And obviously, over the years, your technique improves. When you look at a company and you look at its track record and the various facts about it, you're trying to build a jigsaw on the particular company. And so if I was to, say, select 10 stocks now that I'm not already in, I would work on the basis that hopefully 2 or 3 would be real successes, 2 or 3 would be reasonable successes, 2 or 3 wouldn't do anything, and I'd be very disappointed if more than one really lost money and I got one really wrong, as it were. But that comes from, obviously, over the years, learning and recognizing, learning from the mistakes one's made.
It's an interesting point that you make about long-term investment. At what point do you actually look to realize your gains? Because you mentioned Treat, oh, it's come off slightly now, it's there, but you still value it and believe it's a good company, etc. But that element of realizing gains is quite a difficult one.
It's very difficult. It's not quite difficult. It's very difficult. And there is no real There's no real certain answer to it. If anything, the criticism of myself is that I'm probably too loyal to companies. And because I like to develop a relationship with them and get to know the chief executive or the finance director and maybe have lunch or dinner with them, and talk to them frequently, you almost feel a little bit guilty if you actually sell the stock, as it were. Uh, so I've tended to hold on, and sometimes good profits have slipped away. But on the other hand, with so many small caps and having had so many takeovers, that really has been probably my main exit, unless I've got really bored with something or realize that I've got it totally wrong, as has happened occasionally.
But it's interesting, the access to management teams, being able to talk to them, gain trust in them, is a very important part of investing and something that retail investors should have greater access to, one should have thought.
Definitely. But I think now, certainly in terms of the information that's available through city columns and through the web, of course, and through the regulatory news that is published, and webinars and podcasts and investment conferences, there are ways. But the other fundamental point I would make is that I think individual investors should be a little bit more on the front foot themselves. And in this day and age, you can easily pick up the phone or send an email or write to the chief executive or the chairman or the finance director. And in almost every case, I'm sure that they would respond. And if you said you'd like to meet or you'd like to visit the factory or whatever it is, they would agree, even if they regard you as a little bit of a bore, as it were, and I'd rather not do it. Nevertheless, this day and age, they most do appreciate the interest made, and of course, you can also attend the annual general meetings. And I used to be a great AGM attender, not for the formal part of the meeting, which normally goes through in 5 minutes, as it were, but for the opportunities afterwards to circulate and talk to the board, and have a bit of FaceTime and get to know the people, and then build a relationship to the extent that maybe 6 months later you can pick up the phone and say, we did talk at the AGM, or write a follow-up letter. And so I certainly used to be a great AGM attender.
Yeah. Just with regards to diversification in your investment portfolio, how important is that?
Diversification.
Yeah.
To an extent, I mean, obviously, one must have a certain spread, but my own view is that most people have too many different stocks,
Yeah.
and so
And are you mainly stocks or investment funds or ETFs? How do you sort of...
I'm entirely stocks, entirely stocks, entirely equities, and entirely UK equities. I don't.
No cryptocurrencies?
And certainly no cryptocurrencies. And I don't regard, I get very cross when people use the word investing in cryptocurrency, because you're not investing in cryptocurrency, you're speculating in cryptocurrency. And if you want to do that, that's fine, but you're not investing. Investing is what people like me do when they buy a stake in a real company. Diversification, I don't believe that you can have sort of 40 or 50 companies, and you can value them all as highly, as it were. Clearly, almost by definition, there are some that you favor
How
more than
many do you
others.
have in your portfolio?
I think I'm probably more like sort of, well, I would say there are probably maybe 15 to 20 significant holdings, and then a few smaller ones that are less relevant. But I've come to today to a mix in my portfolio, or particularly in my ISA, where I have a combination of both the big cap high yielders, which I think are great value at the present time, the Avivas and the Legal and Generals and the M&Gs and the Phoenixes, which generate income, and then a whole range of smaller cap stocks that I've been in for some time, where the dividend yield is lower. But the combination of that gives me quite a satisfactory overall dividend yield, which certainly in the ISA I'm still pretty well reinvesting. But in my non-ISA portfolio, I take that income out.
Very good. Now, obviously, Rachel Reeves' recent budget in October. What impact do you think that will have on our listeners, retail investors, over the next sort of 5 years?
Well, I think the jury's still out. As a private investor, purely from a personal point of view, I was quite relieved with the budget. In that, they only put capital gains tax up to 24% for a high taxpayer from 20, and I thought it would go to 30. I didn't believe that it would go to the same level as top rate of tax 45, but I did believe it would go to 30. So I was quite relieved that it went to only to 24%, which one could live with. And secondly, the continuation of inheritance tax relief on AIM shares, although it was cut in two, still made the AIM market, or makes the AIM market, quite attractive. And so after the budget, we saw a small bounce in AIM stocks. But I actually thought that capital gains would go up to 30% plus. So I sold a couple of my non-ISA holdings that were substantially pregnant with gain, and took that 20% CGT on the chin. Because I thought CGT was certain to rise, which of course it has done, but also to give me a war chest, a pot of liquidity, which I could reinvest after the budget. And so I'm in the process of doing that now.
Very good. Now, one comment from people is that the British remain reluctant to engage. What do you think people can do to improve the retail participation in investing?
Well, I think, first of all, I think it can start from, or should start from schools. And the financial education in this country is abysmal. It really is a tragedy, and the youngsters appreciate it themselves. So many leave school with hardly any knowledge of budgeting, or banks, or mortgages, or deposits, or interest rates. And in fact, just going off at a slight tangent, I wrote to Jeremy Hunt when he was Chancellor, along with, it was my idea, with 3 or 4 Conservative peers of some seniority, urging the Chancellor to gift £5,000 worth of NatWest shares, from the government's big block of NatWest shares, £5,000 worth of NatWest shares to every state secondary school in the country, of which there are about 4,000. And Hunt was taking it quite seriously and had his officials look at it. And it could have come to pass, but of course he was, obviously the government was defeated. Now, the whole idea of that would be to gift the school £5,000 of the NatWest shares that they would have to hold for the long term, and that £5,000 would deliver a £350 dividend. And that dividend, this was my scheme, my idea, how that was spent in the school was up to the senior pupils. They would vote for whether that they should reinvest that in something else, or buy something for the school laboratory or the library, or subsidize a school trip, or support a local charity.
But understanding the value of money.
But understanding the value of money, and for the first time beginning to understand, because they own shares in NatWest, what a bank was, and what a dividend was, and what a share was. And of course, I think in the case of NatWest, they would have probably sent managers in, or officials, executives, to talk to the schools. So my idea was to really, through this method,
and a very practical.
It was practical, and it would have been different. But I'm afraid, the Treasury is not the world's greatest at thinking outside the box, and something that's a bit different that are. So financial education has got to be improved dramatically. But also, and I've campaigned on this over the years, I think there's been a massive failure by television in covering the stock market and investment opportunities. And I think it's a great loss to the nation, because we've got so many exciting companies to invest in this country, that could be brought into people's homes through the medium of television or similar, and really encourage people to actually make their own decisions and invest some of their own money, rather than just leave it in funds, or worse still, just leave it in the bank.
Absolutely, absolutely. So, if I would say to you, what top tips would you give to retail investors?
The top tips would be, do some research. So you must do some research, as it were. Before you invest in a business, endeavor to understand it and like the business, as it were. I mean, I personally won't invest in cigarette companies, for example. Some people won't invest in defense companies, but so you understand the business, you like the business, and then and you want to invest, in my judgment, in businesses that are already established and that are profitable and paying dividends. Now, of course, you can invest in startup businesses or biotech businesses, and if you get it right, they can do very well indeed. But certainly initially, one should be more cautious and only invest in established companies. And above all, once you do invest, be patient and don't expect too great rewards too soon.
Patience is a virtue, though, some.
Patience is a virtue.
So, final question to you. If you could go back and advise your younger self about investing, what would you tell him?
I think I think I would probably tell them, repeat those broad things that I endeavored to understand myself. But not only I would say, can investment be profitable and build up for you a degree of financial independence, but actually it can be very enjoyable and interesting. And so the stock exchange and stock market investment has been very much part of my life, a big part of my life, which has given me huge interest, huge pleasure, and has helped to put bread on the table.
Well, Lord Lee, thank you for your time today.
My pleasure. Thank you.